A former Fed governor says the formal end of QE2 will not have much direct impact on stock and bond markets. But still, Randall Kroszner points out that when the Fed started to shrink its balance sheet last year, the economy did start to deteriorate. What happens this time? Well, Randy Kroszner was at the Fed for almost 3 years. As you can see, he's with us now. He's an economics professor at the University of Chicago's Booth School of Business. And he joins us from Chicago this morning. Welcome to In Business. How much of a soft patch and how long will this patch last?
Well, I really wish I had a crystal ball. Unfortunately, I don't. But I think just 1 month of soft numbers do not a new forecast make. We really need to see whether this is just due to one-off factors related to the tragedy in Japan and the consequences for the global supply chain, or whether it's something more deep. People seem to forget that Japan is still roughly the second largest economy in the world and is still very, very important for global production. So yeah, a major disruption there has an effect everywhere.
Well, they certainly seem to forget that when the tragedy happened, because there were a number of economists who came on and said it didn't matter anymore. But as you say, you think that that's what's showing up in our numbers now? I mean, in addition to that, we are seeing housing prices still declining and job creation not happening, as Ben Bernanke said, frustratingly slow.
Oh, I agree. And see, the question is this just a one-off thing due to the tragedy of the earthquake in Japan, or is this now something that is really a beginning of a slowdown? I think we really need to see next month's numbers on the jobs report. Mm-hmm. If they come in weak also, then I think you can't make the case that it's just transitory, or it's not as easy to make that case. Then we have to worry a little bit more about an extended soft patch.
Well, market watchers often say, you know, economic indicators are backwards looking. What is forward looking are what the corporations are telling us. And while we're hearing that inflation may be transitory, we're hearing from clothing companies that they're about to raise prices going into the back to school season. We're hearing from Nestle. We're hearing from food companies that prices are going up for them, whether it's corn or whether it's just the cost of creating foodstuffs. So tell me your read on inflation for the consumer right now.
Well, I think that's right. What we've seen is a little bit of a turnaround in inflation. It had been getting dangerously low last summer, and inflation expectations were getting very, very close to the dangerous Japan-like deflation levels, and I think that was the motivation for QE2. We've raised inflation and inflation expectations up a bit, and we're starting to see some of those increases in prices in commodities elsewhere starting to show up in consumer prices outside of energy. And I think we'll see a little bit more of that, but I don't see a major inflationary pressure coming, partially because of the continued slackness in the labor market, as Chairman Bernanke emphasized.
But I understand the read to say, as an economic phenomenon, it might be transitory. But that pain for a consumer isn't fleeting, right? It's going to affect their budget. It's going to affect their planning. It's going to affect their confidence. Yep. So how can we truly say it's just going to disappear?
Well, the pain is there, and the pain is real. The question, as you had said, is what's going to happen in 6 months or 12 months from now with respect to the price level. And that's really the key for what the Fed needs to be thinking about, because they've got to try to make policy going forward. Monetary policy has an effect with a lag. So you have to think about what are the inflation pressures going forward. And I don't see them being tremendous. Certainly some are there. We don't see a lot on the labor market side. We've started to see a little bit of cooling in many of the commodity markets, not all of them, but many of the commodity markets. So going forward from here, I don't see enormous pressures. But we certainly have seen a turnaround from when a year ago inflation was getting dangerously close to zero, and now core rates are up in the low ones. Headline rates are certainly higher. But gasoline prices are starting to, a little bit of the sting is starting to come out of them. But they're still stinging, and there's no doubt about that.
Is an employer payroll tax holiday the most efficient way to create jobs?
Well, certainly that is something that can be very helpful for giving incentives for job creation and incentives for getting more money in people's pockets. Because one of the things that Chairman Bernanke emphasized was that there are fewer people working, a lot fewer people working. And because not only is the unemployment rate high, but there are fewer people participating in the labor force. And that's one of the key concerns going forward, that even if the unemployment rate comes down, we may not get income up because the wage rates are not moving up very much, and there's not as many people working.
Governor, I would love to keep talking to you, but I've got a hard break, so we're about to get cut off here. Thank you for your time.